In this video, we're going to be looking at the operating activities section of the statement of cash flows. The operating activity section of cash flow details the inflow of cash and the outflow of cash related to the day-to-day operations. And this is accomplished in one of two manners: using the direct method, where each activity is given a specific line item and you're told whether it's an inflow or outflow, or the indirect method, which determines the cash flow from operating activities by removing the accrual effects of our bookkeeping from the income statement. So let's begin by looking at the direct method. And this is an example from a textbook over on page 219 of the custom book, 201 of the hardcover book. And we have this fictitious company, Arlington Lawn Care, and the authors, for demonstration purposes, put this together, but also the fact that there are very, very few companies that report under the direct method. In fact, I could not find an example. In the direct method, we begin with the inflow of cash from customers. That is our main source of cash. We may have other instances where there will be a cash flow from investing activities, the receipt of interest and dividends. And then we have outflows, and our outflows are for things like you see here: the purchase of inventory, wages, payment of wages, income tax payments, and pay particular attention to this: the interest paid on loans. Why? Well, remember, on our income statement, we said that interest on loans is reported outside of operating activity, that it's a financing cost. However, on the statement of cash flows, there is this disconnect. It is reported as an operating activity. And in our section about where we're headed, we'll talk about how FASB has decided to correct this situation. So our cash inflows minus our cash outflows gives us our net cash flow from operations. And it's important to understand that regardless of the presentation format that we use, both the direct and indirect method will produce the same cash flow. And this is over from the next page, 202 of the textbook. This is our indirect method. Note that it begins with net income. That tells us that this is the indirect method. From net income, which is reported on the income statement based on accrual accounting, we have to make certain adjustments. Now, we will be covering this in depth in ACC 411. For right now, you just need to know the difference in the formatting, not so much in the calculation of the amounts. So in the indirect method, we will begin with net income. We will make adjustments for non-cash effects, and then for changes that occurred in current assets and current liabilities on the balance sheet. So the indirect method will use both the income statement and the balance sheet to derive the net cash flow from operating activities. And again, this has to be the same under both methods for this to be useful, and it always will produce the same amount. So there are visual differences, but the reporting amounts are going to be the same. So let's take a quick look at some of the items that are reported in the adjustment. We have depreciation expense. Depreciation expense, like certain other types of items reported on the income statement, does not have a period cash flow. Depreciation expense is the allocation of the cost to acquire an operational asset over its useful life. For the purposes of the statement of cash flow, the acquisition of that asset is an investing activity. The depreciation expense does not involve cash. We'll have to make adjustments from gains and losses from the sale of operating assets that are reported on the income statement and affect net income. But on the statement of cash flows, we're not reporting just the gain and loss. We're going to be reporting all the proceeds from the sale of equipment. So we'll be reporting proceeds and not gains and losses. If we had a gain or a loss, that would have to be added back in. And there are certain other non-cash items. We're going to take a look at Lowe's statement of cash flows, and it has a couple of examples. So why don't we switch over and take a look at a real company's statement of cash flows. Okay, this is our statement of cash flow from the Lowe's Corporation, the same one we used to look at the income statement and balance sheet in previous videos. And again, the first thing we're going to note here is that the statement of cash flow covers a period. We present 3 here in the Lowe's cash flow for good comparative data for our users. And it begins with net earnings, which is, of course, another way of saying net income, which indicates that Lowe's is using the indirect method. We'll then present our 2 groups of adjustments that we're going to make off of net income. The first involves non-cash transactions, and they begin with depreciation and amortization. Amortization is the allocation of the cost for intangible items. Again, we'll study them more in Intermediate 2. So we're going to add this back to net income. We have certain other non-cash items, and again, these are all very technical and things that we are going to touch on in future courses, such as the effect of income tax. There are certain things that are reported on the income statement related to income tax where the cash payment will not be made for another time period, so the cash flows do not match. Again, we have the losses on the sale of property. Well, we're reporting not just the gains or losses, but the full net of the proceeds from the sale of the property and other assets in our investing area. Then we have certain losses related to fair value of long-term debt and expenses related to the payment of compensation in the form of stock. These are items that are more advanced and we're going to talk about in ACC 411. For right now, just realize that there are certain non-cash items that are reported on the income statement that affect net income that have to be adjusted out in the statement of cash flows. And the next is the changes in operating assets and liabilities. These come from the balance sheet, and as we'll see in ACC 411, when we have changes in these accounts, depending on whether they're an asset or a liability, whether the account balance is increasing or decreasing, that is going to be an adjustment that'll take us from net income to the cash provided by operating activities. We then total up our income plus or minus our adjustments to come up with our cash provided by operating activities. We expect this to be a positive amount. In our next videos, we're going to be looking at the investing section and the financing section.